Good evening and welcome to this summer conference of ATEL. Thanks for coming. I know that a lot of people will keep joining, but let's start to respect the timing. Thanks for coming in this auditorium. Although the weather is quite good, but the good news, the cocktail will be outside, so we can enjoy the good time and the weather. So. For this conference, we have four sponsors, and I want to thank the four sponsors. AREN, sponsors that we are used to welcome at ATEL conference. We have HSBC, FIS, and PwC, and I want to give a special thank to PwC for hosting this conference in this auditorium. So we have different speakers. Let me introduce the speakers. So we have Alain Gomez and Alexander Masquela from AREN, and I will explain what they will address. We have also Philippe Foster and Amir Fezic from PwC, Mark Williamson and Anna Tavano for HSBC, and Mia Mamol from FIS. That's the order. So what are the topics we will address today? We have diverse topics. Some are more related to taxes, some to compliance. It's an important topic, but all are hot topics in my view and quite important for you as corporate treasurers. So we will start with AREN to talk about the taxes and transfer pricing, and also the transposition of the regulation into Luxembourg law, if I'm not wrong, explain dispute resolution, these kind of things. So I'm sure that the tax changes under the bill law 81, 86 will be quite interesting, and it's important to know what you need to know and to apply to be compliant. Then we will continue and we'll talk about EMIR. EMIR could be viewed as a compliant issue. Some people say, yeah, EMIR is already under control. As you maybe know, or maybe not, it's under review, so it's quite important to talk about EMIR and what could come in the review of EMIR, and we don't have necessarily good news regarding EMIR, but I'm sure that Philippe and Amir will talk about that. Then we will have a double presentation from HSBC. Anna will start and present why it's important to work with a global bank, and especially these days where we know that the counterparty risk is coming back to corporate treasurers, and it's a big issue. And then Mark Williamson will talk about digital currency, digital assets, metaverse, NFTs, very interesting topic. And we will finish with Mia from FIS. She will talk about the unlocking of the future of finance with AI. So very interesting topics. After that, we will have the networking. Outside, we will have to go up and to go to the terrace. So it's time to start. So I will invite our two first speakers, Alain and Alexander, to join me, and maybe we can start. So the remote control is there. You have the mic.
Thank you, François. Warm welcome to everyone. So my name is Alain Goebel. I'm a tax partner at Anna Meenach, and I'm joined by Alexander Masquela, who's a tax counsel in my team. And we both work in transfer pricing and in transfer pricing litigation and litigation more generally in tax terms. What we wanted to present you today is something where we wanted to create awareness, because it's something that touches the taxpayers' rights, which is something as lawyers that we care very much about. So there is the Bill of Law 81, 86, and if you didn't have had the opportunity to go through it or to read about it, we wanted to summarize you a few points of attention. Let's go. The big issue with this Bill of Law is that as I said, it reduces significantly the taxpayers' rights in the fiscal procedure in Luxembourg. As you may know, the tax procedure in Luxembourg comes from Germany. It is under the Second World War, the German occupation, that the rules have actually been introduced in Luxembourg in a law that's called Abgabenordnung, so general tax law. And this law is not extremely taxpayer friendly, as you can imagine. After the war, the government needed to collect taxes, and what they did is they decided to just simply maintain the tax rules that were imposed by the German for simplicity reasons, and it turned out that for the government it was actually a good thing because it was quite efficient. Now the Abgabenordnung has been criticized a lot in the last years, and there was a certain pressure, a certain push that it should be completely overhauled, and new rules should be implemented that protect better the taxpayers' rights. What the tax authorities did is exactly the opposite. They created a bill of law where they asked nobody their opinion. They did it in their own backyard, so to say, and they ended up with a text which is now before Parliament, but which is highly criticized. It's highly criticized by lobbying groups, but also by political parties. So they are aware that this law may cause significant issues as regards taxpayers' rights. I summarize here a few that seem to be the most important in my view. To create awareness on that. So the first one is that the law basically adds formalities when the taxpayer wants to file a complaint against the tax assessment. The rule so far is quite easy in the tax procedure. If the taxpayer gets the tax assessment that he thinks is not correct, he has 3 months as from the notification to send a complaint to the tax authorities. And this complaint is being sent to the head of the direct tax authorities. So it's the most senior person at the tax authorities. And in order, the basic idea was that this option should be open for everyone in the population, for non-sophisticated taxpayers as well as for sophisticated taxpayers. So there are absolutely no formalities. It's enough if you send a letter and you say, this is a complaint, I don't agree with the tax assessment. And from that moment on, the head of the tax authorities is actually obliged to review your case from A to Z. So she has to review everything like in the first instance where the taxation office actually assessed the tax, and she has to rule in favor or in disfavor of the tax authorities. It could be very well that the taxpayer, for example, is not sophisticated enough, that he has certain entitlements that he doesn't necessarily know. But when the head of the tax authorities sees that, she is obliged to rule in his favor and to add this in his favor. And that is basically the idea. It's a little bit as if you are in a hotel and you are not satisfied with the service. What are you going to do? You're going to call the head of guest relationships. So you go to the person that is in charge and has the responsibility and asks, I think there's something not correct with my assessment. Can you please have a look and review it again? That's basically the taxpayer's rights for now, and it's the guarantee that he will be treated correctly. And that will be more limited under this bill of law, because now you have formalities, you have the timelines, you have the indications that you have to put in the request, and if the formal indications are not in the request, then it's simply void. The tax authorities can leave it aside, send you a letter telling you that they will not further look at it, and then you are time-barred and it ends there, you have to pay the tax. So that is clearly a provision that is extremely against the rights of, let's say, non-sophisticated taxpayers. The second one is they introduced a time limit that is not there yet. As I said, when the taxpayer for now files a complaint to the tax authorities have the obligation basically to review the case. And that is very clearly set by case law, that it is their obligation to review the case. And they have 6 months to do that in order to accelerate the process. They only have these 6 months, and after 6 months they should ideally have informed the taxpayer. If they fail to do so, the taxpayer should not be further barred from going before court, and he's allowed to seize the court after the 6 months if there is no decision from the tax authorities and there is no time limit to seize the court. But this does not mean that the tax authorities have not the obligation to respond they do, and the judges have clearly confirmed that even in a very recent case law in January 2023, where they opened the door more or less to say if they did not respond, then this might open possibility for the taxpayer to claim damages. And here the response of the tax authorities in the Bill of Law is to change the provision and to say, okay, we have 6 months to respond. If we don't respond, it's a no. And then you have, and that's also something new, you only have 12 months then to seize the court. So again, it's a limitation on the taxpayer's rights. What's the reason? And if you look at the parliamentary works and the discussions in Parliament, it appears very clearly that the tax authorities for the time being have one big issue, and that is they have too many claims and not enough people. They have an office of 16 people that treat these type of claims, and they have 8,700 pending cases. You can imagine the backlog and the impossibility, materially speaking, of dealing with it. But the big question then is for us: is it good that the taxpayer then has to suffer for this inefficiency? Most likely not. But that's what the Bill of Law foresees. Another one is quite strange. Another provision requires the taxpayer, if he wants to enforce its rights against the tax authorities, he has under corporate law the obligation, as you all know, to file the annual accounts with the company's register. And here the provision says if they are not filed in due time, they are not enforceable against the tax authorities. So we can simply ignore them, which is a very bad thing, because if the tax authorities ignore or are allowed to ignore the annual accounts, they say, okay, the accounts are not valid, so we can do a taxation d'office, which is an assessment unilaterally by the tax authorities based on their estimation. And nobody really understands why this sanction should come, because you do have sanction already in the Luxembourg corporate laws. If you don't file your annual accounts in a timely manner, you've got the liability of the management and so on. You have even a criminal liability. So to add another layer of a tax sanction does not really make any sense. And you do have certain cases where it is impossible to file the annual accounts on time. We saw cases in the past where companies had been liquidated, the managers were no longer around. You have the liquidator who has to find all the pieces of the puzzle. It takes time, and so there are some legitimate reasons why the annual accounts could not be filed in due time. The tax authorities can also request the annual accounts and the documents to be communicated in electronic form. I don't think that's that negative. Other provisions actually increase the cooperation between the tax authorities and, on the one hand side, the CSSF, and on the other with the Commissariat aux Assurances. And then we come to the taxation d'office, and here it's quite strange, but the tax authorities have included a provision where basically the taxpayer is only entitled to challenge its tax assessment, which is based on a unilateral evaluation by the tax authorities, if the gap between the valuation and the actual situation is exceeding 10%. That's a proof that is extremely hard to bring, and that can be contempted from the tax authorities again. So this also is clearly a provision that has been included by the tax authorities just to simplify their life and to say, okay, we're gonna for a whole number of cases there is no challenge, no possibility of challenge by the tax authorities. Other provisions regard the time bearing of claims that the taxpayer missed because of reasons that are legitimate for him. There, the new rule would be that they can only be overcome if there is indeed a force majeure. A force majeure is clearly defined, and it's very limited cases. On the debt recovery, there's also a suspension on the statute of limitation. As you may know, if under the Luxembourg laws that implemented ATEL, in case of an exit by a company from Luxembourg, basically all the hidden capital gains would become taxable, but there is a suspension of the payment of the tax for a certain amount of time. And what they do here is they suspend at the same time the statute of limitation. So this can be extremely dangerous because is it then when the tax is actually being paid because the real exit is happening, that the tax authorities they are then free to reassess the situation retroactively at that point in time, and they look at it typically with the eyes of the legislation that is applying at that point of time, and not the legislation that was in force when the exit actually occurred. So again, that's for the taxpayer, it increases significantly the uncertainty of the tax treatment that will be applied to the exit a few years down the road. So I think those are the main measures that I wanted to mention, and where I wanted to create awareness. It is a pity that this bill has been drafted in the way it is, and I think in Luxembourg they are all the market players are more or less on the same page on this. What would be needed is a completely overhaul of our general tax law, of the Abgabenordnung, which the Germans had already done in 1977, and there should be a coherent and updated text which provides sufficient rights for the taxpayers, and not something like this that reduces them, and it is only written in favor of the simplification or to simplify the tax authorities' life, and it's the taxpayer that has to suffer for the inefficiencies. I turn it now to my colleague Alexandre, who's going to speak to you on the transfer pricing part of the law.
Good evening. So yes, in this draft law, we also have some upcoming changes in relation to transfer pricing. So mostly on the TP documentation side, but also regarding the advanced pricing agreements and the mutual agreement procedures. So we will start first with the advanced pricing agreements, the so-called APAs, as they propose to have a new procedure for the bilateral and multilateral APAs. So if we do one step back, what is an APA? So typically it's a sort of an agreement between a taxpayer and tax authority in order to determine in advance what would be the pricing of their intra-group transaction. So APAs, in essence, they are a very powerful tool because it allows to prevent transfer pricing disputes, and they provide taxpayers with certainty as to the treatment of their transactions. So the APAs, they can be unilateral, involving only one tax authority, but they can also be bilateral or multilateral when the transactions, they occur across different jurisdictions. The draft law and the draft Grand Ducal regulation, they foresee a new procedure for the bilateral and multilateral APA, whereby the request has to be made to the head of the Luxembourg tax authorities, and then the negotiation of the APA itself between Luxembourg and the other jurisdictions will have to follow a specific framework. And this framework is the framework of the mutual agreement procedure. Finally, there is also a precision as to the fees, because it's not free for the taxpayers to apply for an advanced pricing agreement. Typically, the tax authorities will ask an administrative fee for processing the APA request, which ranges between 10K and 20K, depending on the complexity of the file. So now we have seen the APAs, which are very efficient to prevent transfer pricing disputes. But sometimes when we don't have APA in place, it may be that the tax authorities they don't agree with the transfer pricing treatment of transactions, and so they do some adjustments, some transfer pricing adjustments. They increase maybe the income at the level of a particular taxpayer, and then in this case, taxpayers can suffer from double taxation. And the mutual agreement procedure it can help to solve this double taxation. But to implement a mutual agreement procedure, a MAP, you will need to reopen the taxation. And this is why we have now this clarification in the draft law, which forces the possibility to reissue, withdraw, or amend a tax assessment following a MAP or an arbitration decision. Finally, and most importantly also, on the TP aspects, we have the introduction of new TP documentation requirements with the introduction of a master file and a local file. So these changes are made to be fully in line with the Action 13 of the OECD BEPS Action Plan, which forces a three-tier approach to transfer pricing documentation. The first piece, it was the country-by-country reporting, which was already implemented in Luxembourg back in 2016-2017. And now the draft law proposed to introduce the two missing elements, the local file. So the local file, here we have the detailed information on the group's transaction in a particular jurisdiction. It's somehow similar to the classic TP reports that you have for the functional analysis, economic analysis, and so on. And then we have the master file. And the master file, here you have the description of what should be included in the master file, which provides only a high-level overview of the group, its business operations, the intangibles at the level of the group, and also some indication of the TP policy and so on. So the provisions of the draft law in relation to transfer pricing are not criticized as such, since they are made to comply with the international standards. It was expected to introduce in Luxembourg the master file local file, as it was already done in many other jurisdictions. So maybe the key takeaways in this respect, it's who is concerned by these obligations. So it's only the Luxembourg resident taxpayers that are member of a group. The concept of group is the same as for CBCR purposes, with accounting consolidation as a starting point, and then also some thresholds in terms of revenues. So the groups should have consolidated revenues exceeding 750 million euro. And there is also another specific threshold for the master file, where here we have a net turnover. We should have a net turnover of at least 100 million euro, or total assets of at least 400 million euro. In terms of the applicability, when it should be applicable, it should be applicable as from tax year 2024. The documentation, it's not to be filed with the tax returns, but to be provided on demand upon request from the Luxembourg tax authorities. So this is something to monitor for you if you have already maybe, if you are in the scope of CBCR and so on, you may also be subject to the master file, local file requirements as from next year. Thank you.
Maybe one point as regards the entry into force. It's foreseen that the whole bill should enter into force when the vote is positive in the Parliament as from the 1st of January 2024. Although the first part, which I explained, is heavily criticized, and there are chances that it will not pass. The second part on the local master files will, I would expect that it would then be cut off of the current draft, and that it would be put in a law that where we are sure that it will pass, like the budget law, because these are international requirements, standards that we have to implement.
Any question for our speakers? Maybe a question for me. You mentioned the APA, so it's a sort of ruling for transfer pricing, if I understand well.
Correct.
Not too expensive. Do you recommend, advise corporate treasurers to, or especially the corporate treasury centers, to have this kind of agreement just to prevent? Because the big question we have as corporate treasurers is how to assess the margin, the spreads we should apply. And we know that the documentation should be prepared in advance, because afterwards it's too late to prepare documentation. And when you have a control, you have a very short period of time to. So, would it be a takeaway to look at APA as a sort of way to prevent or to have an assessment and then to decide if you need an APA or not?
Yes, I think it's always good to have an APA, even more with a bilateral or multilateral APA, to make sure that all the jurisdictions, they agree on the transfer pricing treatment. Because otherwise, as we said, if then we have a challenge and there is no corresponding adjustment in your country, it could end up in a double taxation situation. So it's really important maybe to do that. But there is one thing to keep in mind is that there is an automatic exchange of information. So for this type of agreement with the tax authorities.
And there's also one thing to consider is that although the tax authorities are quite difficult in most aspects, regarding the applications for advanced pricing agreements, unilateral, bilateral, or multilateral, they are very welcoming. So we have very good experiences with them, and they say we, as the Luxembourg tax authorities, we will always have our doors open, and we will always initiate bilateral or multilateral APA procedures with other countries. We cannot guarantee that we will find a solution because it also depends on the counterpart. But in any case, we will do the first step, and we will initiate everything. And so they are also again quite good at holding, let's say, pre-filing meetings for preliminary discussion on these cases. So on that side, I have to say they are very professional and very efficient.
Do we have some, let's say, backgrounds or some precedent? Because I guess that the first controls have been done. So because for us, or for those having not yet been controlled, just to have some ideas of what could be accepted, tolerated by the tax authorities, and what will maybe cause some trouble. So have you some feedbacks, first controls? Have you better ideas of what are the recommendations of spreads to be applied?
The good thing with the transfer pricing is that it's global. So we all most of the countries follow the OECD transfer pricing guidelines. And so this is the basis to determine what should be the arm's length price. We have a set of methodology on which we can rely. And most of the time, the tax authorities, they interpret the text the same way. So I think it's...
But we could consider that the best practice for corporate treasury centers would be to have at least annually a review of what concerns the treasury and financial TP issues. Yeah.
And depending on the size of the transactions as well.
When we have a big transaction, to make sure that it won't be reclassified. Yes. Okay.
It's worth it, yes.
We've seen a significant increase in tax audits regarding transfer pricing, and I have to say, they are quite complex. And it is quite difficult to handle them, and very often they end up in tax litigation. And we see also a significant increase in tax litigation. And if you follow case law, then you see some landmark cases that have been rendered this and last years in transfer pricing. So the tax authorities we see are extremely aggressive when they see that the rules are not followed, because they have the exposure also towards the OECD, towards the European Commission, and they have a big fear that somebody in these institutions crushes them and reproaches them that they do not correctly enforce the transfer pricing regulations. So that is basically the case. So I would recommend that indeed every year there is a kind of a gap analysis that is done by the treasurers on their controlled transactions, and then it's an arbitrage. Where do I need a full documentation, where it's sufficient to have an economic analysis, and if it's an insignificant transaction, you say, okay, we take the risk and we don't do anything. Yeah. That's a little bit the arbitrage that has to be done.
Okay. I don't know if there... any question? But if not, maybe a last comment. I have the impression that although we will talk very soon about regulation, in terms of regulation, taxes seems to be quieter at the moment. ATEL, where do we stand? Deborah, is that completely stopped, on hold? Do we wait for the new commission second half of next year? I don't think that the Van der Leyen commission will achieve these targets.
But I think that what we hear is that ATAT 3 for the time being is frozen. We have to wait autumn. Apparently in autumn there is a new meeting scheduled to discuss what it will become. But if you have seen, we are a long way from what was the initial draft, which is a very good thing, by the way. We're not sure whether this will lead to anything substantial. There will be a text in the end because it's a political commitment, but it will not. We believe at least it will not be as disastrous or as bad as we thought. Deborah apparently is buried and off the table, and then the big topic for now is of course Pillar 2, and this causes headaches for a lot of groups. And it's a lot of compliance, and the end of the day, not much additional taxes, but
a lot of resources are required to produce the documentation. Okay, so good news on one side, bad news on the other side. But thanks a lot for this presentation. So in any case, they will stay with us, and so if you have any further question, do not hesitate. Thank you. Philippe, Admir, come and join me on stage. So now we will talk about EMIR, and as I said, so it's maybe not the most sexiest or sexy topic we can imagine, but it's quite important, and I guess you will remind us and will explain, and maybe we can try to inform also the audience about the current status of the future EMIR refit we are expecting in the coming months.
Yeah, you just killed my introduction, François, but thanks for it. I was really thinking about, EMIR. And when I say that, I can't see a lot of smile on your face, right? So I was trying today, when preparing a bit the speech, to say how the hell would I introduce that topic, right? And maybe some of you are living here for some periods, and at the time we were listening to the radio, and there were an English radio here. And the way they introduced the traffic info was something like boring, but useful. And I thought, you know what, this is exactly what we're going to go through. So I hope you will consider more the usefulness rather than the boring side, right? But EMIR is nothing new, right? There is some rumor. We know things will be changing. When we talk to our lobbyists, they sharing some potential good news in the corridor. But we still have uncertainties, right? We still don't know what will happen with the definition of hedging, and will you have to demonstrate what is hedging to the regulators, which may be easy from time to time, a bit less from time to time as well. We have uncertainties, about the intercompany transaction, will it be in scope or not? And all of the presentation here will be based on a what-if scenario, right? What if those good news don't come? Because as of today, they're not on the table. Let's be clear. So Admir is the guy to go through the technical aspects. If you just move to the next one. Just to make sure we're all on the same page, what are we talking about? It's quite easy. We have the classic setup, right? You have a treasury center in the middle, and then you may have UK subsidiaries and other European subsidiaries, some Moroccan subsidiaries. They will transfer the risk through internal derivative to the treasury centers, and then either on a back-to-back basis or on a net position, this one will take a derivative with a bank. So what do you have to notify? What do you have to declare? How do you do it, right? And what happens if you don't do it? And this is exactly the questions that Admir will answer. So it's done for me. I got the easy part today. The floor is yours.
Thank you. So thank you, François, and thank you, Philippe. So after that introduction, you can imagine it's quite tough to present something that is sexy or
But usefully said.
It will be useful, I hope. So that is my objective today. It is quite a tough topic. You're seeing it on the screen. It is a topic that is already on the market since 2012, so it's not a new topic. You also see on the screen that there is EMIR Refit, so this should also be known that came out in 2019. But what's more important for us today here in this round, and one of the main reasons why we have decided to present EMIR here today for you, is the EMIR reporting update that came out in October 2022. And this has set off certain waves that we are observing right now on the market when it comes to, well, the general derivatives trading, but also EMIR in general. So for those of you that are not familiar with what was published in EMIR in October 2022, when we talk about the EMIR reporting, so at first we thought, well, this will be another update to the reporting. But I think I will be able to show you later on when we talk about the reporting specifically that, for me at least, it's not an update but a complete redesign of the reporting. So there are quite substantial changes on that front, right? So if you will, we are currently in the middle of that slide or of that timeline that you're seeing on the top of the screen. And the next go live is the 29th of April 2024. So just be aware, for those of you that are not in the financial services sector, the banks are currently heavily working on the implementations of the EMIR reporting. And since the banks are your counterparties, as we've seen on the previous slide, and in certain cases you might be responsible for the EMIR reporting, you also have to be aware that you might be directly impacted. I will explain that a bit further on the next slides. The last point there is EMIR 3, so we are calling it EMIR 3. It's what François already mentioned. So there are draft texts that are prepared that could significantly change EMIR for, in particular, this group here that is sitting in this room. We will touch a bit upon that, so we will also discuss that just a bit. But in general, so let me start with the general presentation. You see it on the bottom of the screen. So we will talk today about the non-financial counterparties. So the financial counterparties, trust me, I have talked to at least 50 of them over the past couple of months, talking about the reporting changes to make them aware of that, because this is a significant update, as I've said. What's important for you here at this stage to understand is that even if you are a non-financial counterparty, you're in scope of EMIR, and you're in fact obliged to notify the authorities, so here in Luxembourg, of course, the CSSF, in case you're trading derivatives. So you have to send a notification, and you also have to provide the name of a person that will be responsible for EMIR compliance within your organization. Okay?
And even if you have only 2 derivatives, I think there is no
That's an important point, because very often we are talking to our clients and the feedback is, well, I just have 2 derivatives per month. For the CSSF, and thank you, Philip, this is really very important. There was a CSSF conference quite recently, and at the CSSF conference, the CSSF said their view is the following. Derivatives are a highly risky financial instrument, and so if the entities are not able to mitigate the risks related to these financial instruments, they have to stop trading them. So how do you mitigate the risks related to derivatives? Well, by applying EMIR. That's the view of the CSSF. That's not my view. I'm just sharing here what the CSSF said there. So yes, even if you only have 2 derivatives per month, you are in scope. We would like to talk a bit about the 3 pillars. So how we intend to present EMIR here today is we will present the main pillars of EMIR. We will give you some key considerations that we have observed on the market that are sometimes a bit forgotten when it comes to EMIR, and also just to give you some best practice or market practice on how to apply EMIR correctly from your point of view. So I will immediately start with the famous classification. I think that everybody who has heard of EMIR has first heard of FCs and NFCs, so financial counterparties and non-financial counterparties. I've shown that on the previous slide. The non-financial counterparties can be, again, structured into two groups, so the NFCs above and below a certain clearing threshold. So the first point here is already for you, if you are trading derivatives, to do that calculation whether you are above or below the clearing threshold. I am in contact with some clients that are telling me, we don't need to do that because we only have these famous two derivatives per month, so it's not necessary. And this is why we are showing it, in fact, here, because the authorities consider if you're not doing it, if you're not calculating your clearing thresholds, basically it is like you are above the clearing thresholds. Basically, the strictest requirements apply to you in that case. So it's really important that if you even have just two derivatives, that you actually document that you calculate it. Of course, the calculation will be much easier for your specific case, but you have to document it. And in case of an inspection, you have to be able to prove that also to the authorities. You have to be able to show why you believe that you're an NFC minus. We will see on the next slides that the requirements will significantly change whether you're an NFC minus or an NFC plus. So mandatory documentation, I mentioned it, and the other point is that there is a notification to both the ESMA and to the national competent authority, so CSSF in Luxembourg, that needs to be sent in case you're above or changing your classification. So at first, if you're calculating and you notice that you're an NFC minus, you don't need to do anything. But later on, if you notice that you are above, you have to send a notification. So this is mandatory. What are the challenges here? Again, market practice from our point of view. So the data gathering, because the calculation has to be done on a group level, right? So it's not just an exercise for your individual firm, but it has to be done on a group level. You have to define the transactions that are actually in scope, and that are used for the hedging. So hedging, Philip mentioned it a bit earlier. So actually what is in scope or what is supposed to be hedging for NFCs, if you're using your derivatives for hedging, they would be out of scope for this calculation. But of course you have to set the scope there correctly. And then you will have practical challenges like having transactions that are in different currencies. Of course, you have to apply, you have to look at them in one single currency, in euro, and also determine what the group transactions are. Yeah? This so much just for the calculation of the clearing threshold and for the biggest challenges in relation to that, but I will talk more about the reporting later on that is changing right now. So, the second pillar of EMIR are the risk mitigation techniques. I will not go through all of them. There is nothing new here that I will tell you about this. There are just certain points that I want to remind you. Basically, we are coming back to the same like what we said earlier. So the processes have to be documented. And not just the processes, but also the outcomes of your, processes and of your calculations or whatever you're doing there. So everything has to be documented and everything has to be shown to the authorities in case of an inspection. And trust me, what we are hearing is that there are inspections, so it's not something that will anyway never happen, right? Even NFC minus must apply risk mitigation techniques. So there are less risk mitigation techniques that have to be applied by NFC minus. The last two that you're seeing on this slide, so the collateral exchange and the daily valuation, don't have to be done. Again, this is why the calculation of the clearing thresholds is important for you. But all the others, so the four others, have to be done. So it's mandatory. You cannot just say, well, with our two derivatives, let's not bother even looking at that. Okay? As I mentioned, the reporting obligation is really the key topic here, because you're seeing it on the top left of the slide in front of you. Today, under EMIR, there are 129 reporting fields that need to be reported for each derivative trade, so it's on a trade basis, and it needs to be reported by T+1 latest. So T means trade date, so 1 business day after having traded the derivative. And now, with the changes that have been that have come into force in October 2022, that number has significantly gone up, in fact, to 203 data fields. This is a huge, huge change, right? Because it's not only that that it's the difference between the 203 and the 129 that have been put on top. No, even within the 129, there are around about 40 that have remained unchanged. So meaning that even in those 129, there are fields that have been changed. This is why we are talking about a complete redesign of the reporting and not just a small update. There is a new data format, so everything is changing, additional complexity, and what that actually means is that it will be much, much easier for the authorities to evaluate the reporting. That's very important at this stage, because so far the reporting, all the different trade repositories were using different formats, or were able to use different formats. So it was very difficult to compare the quality of the data. Going forward, that will not be the case anymore. So it means that the CSSF will be it will be much easier for the CSSF to in fact verify whether you're reporting correctly or not. By the way, 203 data fields, but the deadline, so the T+1, is remaining still the same, right? So there is much more data that still needs to be squeezed in within the same time window. That's the challenge. And of course, that's not all, but because the ESMA and the CSSF have significantly upgraded their supervisory actions around the reporting, you can see they have implemented a dashboard with 19 data quality indicators. Today, I can say it's still today, the review of the quality of the reporting was more done on an effort basis, meaning that if they wanted to, they had to pick a certain entity and they had to go and look it up and check the reporting. Now with these new dashboards, the results will be generated automatically. Basically, there will be pop-ups to notice if somebody is reporting wrongly, which is a complete game changer, right? So just the key considerations here. NFC Plus, even when they are delegating, are still responsible and legally liable for the reporting. That's very often forgotten, unfortunately. And so NFC Plus means if you're delegating to your bank the reporting, you have to make sure that the bank is reporting correctly. In fact, you have to make sure that even the timeliness aspect, so T+1 is respected. And also, you can see it's on the bottom of this page, there is a new obligation to notify the national competent authority in case of significant misreporting. So you cannot just be in that passive role in case you're an NFC Plus going forward, but you really have to take action and you have to identify false reporting. What that actually means is that you need, of course, controls and to do that correctly. NFC minus, there is very often a misconception on that one. NFC minus are not required or not responsible for the reporting when they are trading with an FC, with a European FC, so European bank. But if they are trading with an NFC, so let's say within the same group, or with an FC, so a bank, for example, from Asia or the US, then in that case, the NFC minus is again responsible for the reporting. That's again an important factor that's often misunderstood and forgotten. So on the reporting side, I'm just looking at the time, and I'm being conscious that I have to wrap it up. I could be talking about this for 2 hours, but you're not willing to sit here for 2 hours. I find EMIR very interesting. Just kidding a bit. So yeah, the reporting part is definitely the news of the day. That's why the CSSF had the conference. By the way, just to give you some figures on that, how important this topic is. Initially, the CSSF wanted to do a one-day conference on the topic at the beginning of June. Then very often it was changed to, no, just one person per company can attend. And then all of a sudden it was not a one-day conference, but it was a 3-day conference. So the topic is, again, very, very important on this market. This is the last slide. We just wanted to summarize a bit the main points, how to ensure compliance, just on a general note. First of all, well, assess the applicability of EMIR, calculate the clearing thresholds, all that is linked to that, right? The second point is to identify the person and to notify the CSSF, because you have to do that if you're an NFC. So you will be in scope and under supervision of the CSSF. That's an important point. The third one is to adopt the procedures, really, and to have everything properly documented. So documentation really is key under EMIR. Fourth one is to have controls and quality checks, because most of you will still be delegating the EMIR requirements or the EMIR processes to your counterparty, i.e. to the bank in most cases. The fifth one is to notify the NCA. There are multiple notifications that you can send. We haven't looked into all of them. There are even certain intra-group exemptions that you can apply to. So, but you have to send them, you have to correctly apply. And then, of course, the last one is to stay informed about the regulatory updates, because we have seen it at the beginning. There is EMIR 3 coming up, so that will definitely hit everybody that is trading derivatives.
Is there any question, except François, which we know always have questions?
But maybe to start, first comment, I totally agree, and I remember this conference on the 4th, 5th, 6th of June from CSSF, but we know that CSSF has really a commitment, a duty to increase controls, and having been control at the time was working for corporates, I can tell you that it's extremely heavy controls. They go in all the details, they have access to all the information. If you miss to report one deal, they will know it. So, and I guess that with a new field, it will be even tougher. So be aware. So if you have not been controlled, CSSF, our supervisors, will do that. Same thing at the ISMA level. We think that there is a big pressure, and we'll comment that afterward. So NFC Plus is interesting because it's a question I receive very often. Who are the NFC Plus in Europe? I mean corporates. And apart from Shell, I don't know. If you know any NFC Plus, I'm really interested to know who else will be NFC Plus. But it's a different status, so it's quite important to make sure that you remain NFC.
But everybody can be an NFC Plus if they don't document and calculate.
And
that's
then,
the point.
And then you change the category, and
yes.
So it's completely a story. So it's quite a big issue. And before talking about what could come next, because that's a big issue, do you have any question, or do you have problem with applying EMIR? So you don't have question. Maybe we can simply talk about, because it's a topic that we at EACT level, the European Association of Corporate Treasurers, are working on. It's among all the regulation on the review at the moment, Basel, money market funds, etc. We mentioned some tax issues. Digital euro, we will talk about digital assets. So we have a lot, instant payment, many regulation. But EMIR, it's really top on the agenda of the Spanish presidency, which started a couple of days ago. I don't know if it will be sorted out before the end of this mandate. We don't know what will be next, but the Belgian will be the next presidency, and before the election, I guess if it's not done this year, it won't be done before the next commission. But what is really the risk for us? You mentioned the first risk, and it's a risk that you've not mentioned, but I don't know if you are aware. They remove 4 words or of that group, and by removing these words, we still don't know if it's done on purpose. It means that it will completely change the nature of our function, because it means that a group will not be able to hedge on behalf, and it's really the raison d'être of a corporate treasury centers here in Luxembourg or elsewhere. So that's a tricky one. We have the impression that it could be corrected, but still, if it's not corrected, it's like for payment, PSD2, payment factories are, POBO, COBO, are challenged in France, in Germany, in Italy, so we also try to change the wording and make sure it's clear. The second major issue you mentioned, it's intercompany transaction. Today, if you are a corporate having 2 transaction amounts, you can ask your bank to report. And the good news, a change with refit in 19, it's that the responsibility belongs to the bank. In the past, you were able to push it to the bank, but you were still ultimately responsible. So it means that if we reinstall the intercompany transaction, and if you have intercompany transaction or mirroring, Philippe mentioned, it means that you will start reporting, because you can ask, and you have HSBC or JP Morgan in the room and some other banks, ask them to report intercompany transaction of your group. It's impossible. You don't want to disclose them to the bank or to one bank, and they won't be able to report for you, and it will cost something. So at the end of the day, we have a really big problem, because even large multinational companies have to start maybe reporting what they are stopped to report, providing they receive the exemption, because you need to apply for the exemption for not reporting the intercompany transaction. So it means that it could be a major change. And then you mentioned the last one, the major issues, and the 3 major issues. It's hedging definition, and with Philippe we agreed that it will be better to keep the current definition, an IFRS definition. Philippe is a specialist of IFRS 9, IS 39 definition, which is principle-based. And if we move to, let's say, giving the role to ISMA to define what is hedging and what is not hedging, that will be another story. Because when you are controlled by CSF, and you know, for having some customer of you control, you know that you need to evidence and to demonstrate what is your strategy, and that it's really hedging. If not, it counts on the famous 1 or 3 billion threshold. So just to tell you that we have 3 major issues. The first one, I guess, could be corrected. The 2 other one, we don't know. What are the reasons for that? Because it's like the external procession, 3 steps ahead and 2 steps back. Why changing EMIR refit? Because EMIR refit was correcting something. It's just because of the electricity and energy providers who were, let's say, negotiating, by the way, not OTC derivative, but MIFI, a product collateralized. And it's because of the case in Germany, in Finland, and some other countries that no ISMA is looking for. And the only thing they found to correct will be to change OTC derivative. So it's a pity, but you should be aware that it could come. The good news, the rapporteur, the Polish rapporteur, Mrs. Hübner, is completely in favor of, let's say, keeping the thing like it is. But if not, and we know that when you have a recommendation from ISMA, Commission and MEPs tend to say, okay, ISMA is recommending, it's the supervisors of the supervisors, so it should be correct. Let's follow the recommendation. So it's a big risk. And so you mentioned bank and IT providers, because if we have changes, we need also to discuss with our IT providers, because you have to reinstall what maybe you stopped to do. So it's a big issue, and you need to be informed that it could come. So it's important to explain, because it's not good news. And we try to lobby. It's not an urgent thing, it's not a priority for you, because if it's in force, it could be in 1 or 2 years, but I wanted to make sure that we are all aware of this risk. I don't know if you want to comment and have some...
think we can just say that we can see it stick to your heart.
No, but we have many regulations because money market fund is also important. If we change the money market fund and we remove the LVNAV, that could be an issue. So we corporates who are using, when you're like Airbus, you have 60 something billion cash, excess cash. Of course, you use money market funds. So if we remove the LVNAV, which represents 60-70% of the market, then we have potentially a problem. And the same with Basel III. Cost of guarantee could be increased by 150%. So we have many regulations. That's a problem after a crisis. They try to rebalance the pendulum, and so that could be, and sometimes it goes a bit too far in the wrong direction. So, but okay, that's good news. So it's something that we should keep in mind, and you can certainly help corporate treasurers to review and to revisit the processes if needed. Thanks a lot.
Thank you.
John. So let's go for the two next topic, and we'll start with you, Anna, and you will talk about HSBC and global banking and your views on the market. So I guess.
Yes, absolutely. A much easier conversation. I mean, after the first two presentations. So now I understand why you put me in this at this level of the presentation. Okay, to relax a little bit before Mark start talking about metaverse, digital currencies, and so on and so forth.
Digital assets.
Yeah. So first of all, I would like to thank ATEL and all the members for inviting me to this important conference. It is an honor for me to be here today. And above all, it is an honor because I've been given the chance, as you said before, to talk about HSBC. I see many customers here, and I'm sure many of you already know HSBC, but for the few, and I hope you are really few, who don't know HSBC, let me spend a few words about the bank. The bank was established in 1865 by a Scottish guy who was based in Hong Kong and who wanted to facilitate the trade between Asia and the rest of Europe. After 155 years, today HSBC is a global bank and is one of the few global banks. It is a bank that has got a presence in more than 60 countries, and this is one of our strengths. It is a bank that has got a market cap of 132 billions in dollars, and it is a bank that employs approximately 219,000 people and serve 39 million customers. So we're talking about a huge bank. When I talk about the strength of the bank, I already mentioned one, which is our global network. But the second one is the size of the balance sheet in terms of assets. If you look at our balance sheet in terms of assets, our balance sheet is as big as 3 trillion. Huge amount, and this gives you an idea of what the bank can do in terms of support that can provide to our clients. Now, what is the strategy of the bank? The strategy of HSBC is to become the leading international wholesale bank. What does this mean? It can mean everything and nothing if you think about it, okay? Our purpose is to work with international clients. We don't like domestic clients. We want to work with international clients that value our network, especially the ones that want to grow in the corridors where we have a strong presence, i.e. APAC and the Middle East. And with these clients, we want to provide the right support. We want to provide outstanding financial service, outstanding products in order to help them to grow into those markets. Now, being an international bank, it means we have a presence in many geographical areas, and one of those is Europe. Europe is a very important geographical area for HSBC. Why? I'll give you three numbers. If you look, if you think about the total amount of export, Europe count 45% of the total amount of export worldwide. And out of this 45%, 50% is towards Asia, which is the countries where we have a very strong presence. And if you look at the revenues that in corporate investment banking we are able to generate in Europe, and when I talk about Europe, I talk about continental Europe and UK, I tell you that in this geographical area we're able to generate more than 35% of the global revenues. So this gives you an idea of the importance of this geographical area for the bank. What do we do in Europe? First of all, in terms of presence, post-Brexit, we have established our headquarters in Paris, but we have a presence in 13 countries. So we have people on the ground in Germany, Spain, Italy, Netherlands, Ireland, Switzerland, and of course Luxembourg. In Luxembourg, we have approximately 400 people, divided across different function, product, service, and we have of course a coverage team that is sitting on the ground together with some products with the aim of servicing on the ground our client. The strategy of HSBC, we see ourselves as a relationship bank. We are a bank that wants to work with our client in the long run. We are not an opportunistic bank. And the strategy of the bank is to stay on the ground, know the client, and be able to serve the clients on the ground. Which products do we offer to our clients? I would say all the products, starting from cash management, trade, supply chain finance, receivable finance, credit lending, M&A, acquisition financing. And here is where the size of the balance sheet is particularly important, because sometimes we can enter into the transaction in size alone, in big size alone, without the need to split the risk with other banks, FX hedging or any other type of hedging, equity capital market, DCM, the capital market, equity financing, structured equity financing, all banking product basically. And I would lie to you if I were to say that we are good at all products, because I mean that would mean that I would be extremely arrogant. We are good, extremely good at some product, and I'll tell you for why in 1 second, and we are good in other products. And when I say we are extremely good, it's not something I'm saying, Anna Tavano is saying it. It's that because we have been recognized by the market as being one of the leader bank in some products. And I'll give you some examples. IFR, as awarded us as the best equity capital market house bank of the year. Now, this is an award that has been given for 15 years to American Bank. It's the first year that goes to a European bank, and this bank is HSBC. Oh, still by, and I'm going to finish soon, don't worry, because I think the most interesting part will come with Mark, not with me. So this is just advertising. The second award, I mean, we have been given last year, was as best investment grade corporate bond house of the year. And the third one, we received many. I'm mentioning the one which I like the most. And the third one is ESG Financing House of the Year. Why I mention this one? Because ESG is one of the pillars of the strategy of HSBC, together with innovation. We are very much focused on ESG, and we truly believe that we need to play an important role in helping our clients to transition to net zero. And for this, we have taken some commitment on our own balance sheet. We have taken some commitment with our clients. On our own balance sheet, we have committed to operate with net zero emission by 2030, and we have committed to not finance companies that contribute to the emissions by 2050. And in reality, we have issued a policy that might take us there earlier than 2050. But the most important commitment, in my opinion, that we have taken is that we have committed between 750 billions and 1 trillion to support our clients to transition to net zero. And this is a huge amount, which goes with the comment I was making about the size of the balance sheet of HSBC. I will stop here, otherwise it becomes too boring, and I will leave the floor to Mark, so you're not going back to the tough topics.
So, let's keep the question for after, but start, Mark. But I think it was quite interesting to mention that, and it's good to see that in Luxembourg, a small country, banks like you or global banks have a strong presence and are serving not only the real economy that we represent tonight, but also the alternative funds, family offices, and so I think it's quite important, especially these days where the counterparty risk came back to corporate treasurer's top agenda. So, Mark, let's move to the digital assets, NFT, and metaverse.
Thank you, Anna. Thank you, Francois. And now switching gears a little bit to move away from tax and EMIR and all that sort of stuff. So what we're going to go through today is digital currencies, assets, metaverse, and NFTs. I'm Mark Williamson. I work within the markets and securities area within HSBC with foreign exchange and commodities. So what are the building blocks for digital? Try and keep things very, very simple, and give you guys some information that you can take back to your companies just to help describe what are these building blocks. So it's the A, B, C, D, and E of digital. So AI, and I know Milia's going to be talking about AI a bit later, but within HSBC, we've been using AI for a few years now, and we've got a tool called AI Markets. And AI Markets is within our single dealer platform, and it's also available over Symphony, so a chat room. And that's where we're able to have natural language processing for our clients to ask for pricing, for trade ideas, and actually trade using AI. We're very interested in blockchain, and I'll talk through some of the different tools that we have there. But we've been using blockchain since 2017, 2018, and we have a few different tools. So we've got Mint, which we use for tokenization. We have a digital vault so that we're able to store those digital assets on behalf of our clients. We've got FX Everywhere, which does post-trade FX confirmation and payments. And we have Trigger Chain, and that listens into smart contracts and triggers payments into traditional payment rails. Cloud, we've got a multi-cloud strategy. We use quite a few different cloud providers. Data, so we look at data. How do we consume that? What are the analytics? How do we distribute that data effectively to our clients? And finally, ecosystem. So how do we look at using these building blocks to create the network of networks? And so that's what I look at. And the three areas of focus for myself is looking at post-trade market infrastructure. How do we improve that, embracing some of these new technologies? Tokenization, and I'll talk through some of the initiatives that we've done, and one notably in Luxembourg. And how do we set ourselves up to be the banker of things? How do we set ourselves up to be that digital bank of the future using these building blocks? So we've got a bit of an evolving landscape at the moment. So we're going through this blockbuster to Netflix moment. We're seeing more and more stores of value and payment that are being digitized and streamed to our clients. Also, we're seeing our clients, many of you in the room, that are starting to adopt these new technologies. So whether that is looking at application programming interfaces, the Internet of Things, distributed ledger technologies, and blockchain, looking at how you're implementing that into your supply chains. Partnering is really, really important to us. So whether that's with FIS, whether that's with Oracle, IBM, Vodafone, etc., we can't do this by ourselves. So we need to make sure that we're connecting into your treasury management systems, your enterprise resource platforms, your risk management systems, such that you're able to make decisions within those platforms rather than giving you another user interface to connect into. So how do we embed FX, payments, financing, and how do we help decarbonize your supply chain? So how do we get to that net zero obligation that a lot of us have in this room? And the green, we're finding, is the big kicker in all of this. So how do we use these technologies in order to help our clients decarbonize their supply chain? Partnering, as I said, is really important to HSBC because, again, a lot of these new technologies we can't do by ourselves, so we need to partner. And there's a few key aspects that we look at when we're partnering. People, people make this whole thing go round. If there isn't a good connection and we don't have a common goal in mind, then it's very, very hard to partner effectively. Proposition, what's the big idea? How are we going to move this stuff forward? Partnership, so how do we formalize that? And then looking at the product, launch to market, profit, measuring the success from there. But also, I think, having worked in this industry for over 30 plus years, patience is really, really key. So partnership takes a little bit time to evolve. So how do we look at digital currencies and assets? At HSBC, we look at it as a 3+1. So central bank digital currencies, we're all in. We've been doing research and a number of different experiments since 2017. Most notably, in the end of 2021, we did an experiment with Banque de France, where Banque de France issued a Euro CBDC bond. We brought that bond, we then stored that in our digital vault, we then sold that to a secondary client, a client in the secondary market, and then we rolled forward that experiment one day. On the second day, we received Euro CBDC coupon payment per our client's standard settlement instructions. We then did an FX conversion into a synthetic currency and paid it into their bank account. So as Anna said, we're present in 62 countries, and what we need to do for central bank digital currencies is look at how do we solve the Rubik's Cube 64 times. And what I mean by that is how do we solve for wholesale, retail, token-based, account-based, domestic, and cross-border. So using that particular experiment, we solved for that Rubik's Cube, but we need to do that 62 times by each country brings in their own central bank digital currencies. We also wanted to ensure from a technology perspective that we're connecting heritage to digital, so looking at how do we connect into our existing systems, but also how do we connect the two different blockchain technologies that we utilize. So we used IBM's Hyperledger and R3 Corda, and we used Weaver protocol for the interoperability between the two. Stablecoins is a hotly debated topic at the moment. They're not regulated at the moment, so we don't touch them. We're waiting for regulations to come into being around stablecoins. But I think it's also worth noting that with stablecoins, you've got about 180 billion that's in circulation. If you look at how much goes through the FX and payments market on a daily basis, you're looking at 18.7 trillion. So it's a really, really small amount of money that's in circulation for stablecoins. Cryptocurrencies, like every other bank, we do not touch the cash, we do not touch the underlying, but what we are able to do, and within our risk appetite, is to trade exchange-traded products through regulated exchanges that is settled in fiat currency. So what does that mean in English? That means that we are able to trade US dollar Bitcoin futures on the Chicago Mercantile Exchange and settle in US dollars. So when the news came out a couple of weeks ago, or maybe even last week, that HSBC's trading cryptocurrencies, we're not. Again, it's exchange-traded products through regulated exchanges and settled in fiat currencies. So that is the same for HSBC and for a number of other banks that are in the room as well. We do look at tokenization, and I'll go through that in a moment. So we are all in on tokenization. So just looking a bit around the industry evolution and also reflecting upon my career. When we look at Web 1, 2, and 3, is there a tweet for that? You bet there is. Right? It's very simple to remember. Web 1 is about read, Web 2 is read-write, and Web 3 is read-write and own. So when I was in a German bank, late 90s, early noughties, and we were building the first single dealer platform, I had one of the head traders come up to me and say, see EBS, I want that on the web page. And that was a design spec. 2 flashing numbers on a web page. And had all the people within this particular bank saying, why are we using the internet? It's never going to take off. That's crazy, Mark. What are you doing? That's silly. Stop it. And then in the mid-noughties, I'd moved to an American bank, and we're starting to implement a single dealer platform there. And we're moving into read-write. We're starting to see companies like Facebook, Twitter, etc., the social web starting to come into being. And when I was at the American bank, we're looking at how can we differentiate ourselves. And so we looked at mobile phone because mobile phone was the thing that was coming in. And so for those of you who are old enough to remember the BlackBerry with the rollerball, also iPhone 3. So we managed to provide the ability for our clients to leave foreign exchange orders on their BlackBerry and iPhone 3, I think it was at the time. And when I was doing this, regulation, compliance, everyone was saying, why are you doing that, Mark? No one's going to use a mobile phone on their daily basis. I can tell you now, although it's encouraging to see, getting people off their mobile phone anywhere at any time at the moment is impossible. We are living our lives on mobile phones. So now we're starting to move into Web3. That's the internet of money. And there's a few different building blocks that build up the internet of money. So first of all, around blockchains, coins and tokens, DeFi, and the metaverse. So we're starting to look at how do we own parts of the internet and the infrastructure. We have a DLT backbone, as I mentioned before, so Mint, where we're tokenizing different assets. So Project Orion you may have heard of, which is a bond issuance that we did on-chain out of Luxembourg for AAA rated bond, AAA rated sterling bond with EIB. We're also looking to tokenize things like gold, digital vault, so we can store those different assets. FX Everywhere is our longest standing DLT solution since 2018. We've settled $6 trillion over that platform, and that does PVP. But where it's unique and different is it does PVP, or payment versus payment, for emerging market currencies. So currencies like CNH, which is a big benefit for ourselves and our clients. And Trigger Chain, as I mentioned before, that's how we connect into or connect smart contracts into traditional payment rails. Now, typically, when I mention the metaverse, I get a bit of an eye roll from a lot of people. They go, well, what's the metaverse? Similar to iPhone back in the mid-noughties. So there's 3 different ways that you access the metaverse. There's the goggles, and we've seen Oculus goggles. We've seen Vision Pro that's started to come out. There's also augmented realities, such that when Nick's playing Pokemon Go in the park with his children trying to find Pikachu, that's augmented reality. And we're starting to see mixed reality come into being as well. So there is a partnership between Meta and Ray-Ban where they're starting to put information into people's glasses such that they're able to direct around into a store, for example. And we're seeing different categories evolve. So the industrial metaverse is very much in use today by a lot of companies. So they're looking at that for using glasses or goggles within factories to make sure that the right tools are with the right people to manufacture the right goods, or making sure that when a ship lands into the port, then they're making sure that the truck or lorry goes to the right port. And also digital twins. So we're starting to see people creating different rooms or buildings and being able to hold up an iPad and see what's behind the wall and whether that needs to be replaced. Supply chain metaverse is where we're starting to see the digital representation of goods as it moves along the supply chain, the physical and digital representation of those goods. And the consumer metaverse, we're starting to see become more and more prevalent amongst consumer product groups, luxury brands, and motoring. We're starting to see they're using it for brand amplification, for building communities and new revenue streams as well. And all of this is powered by DLT, IoT, and application programming interfaces. So how does all this fit together? And I'm going to pick on you, Anna. I'm sure you're pleased about this. So this is looking at, if you look at and I'm going to pick a brand, just randomly pick a brand. If Anna's been looking at a Louis Vuitton Speedy handbag. Okay, so as we can see, we're looking at the industrial metaverse. We can see that the leather's been sustainably sourced. It's in the factory. You can see it being manufactured in the factory, and then it goes into the supply chain metaverse. So we're seeing that bag being transported from the factory to the store. And what are we able to do there? We're able to embed FX, payments, financing, and also measure how much carbon's been burnt as that good's been moved along the supply chain. So we're able to decarbonize its supply chain. And then as Anna, when she comes around and visits London, she's walking down the street past Harrods, and a message will pop up in Anna's glasses and will say, hey Anna, that Louis Vuitton Speedy handbag that you've been looking on online is physically available in store. And so Anna will say, that's great, I'm going to walk into Harrods. And she walks into Harrods and directs it to, well, with the IoT, it's one of the telcos we're working with. On the SIM card, they've got a digital wallet digital ID, connectivity into blockchain ecosystems, and smart contracts. So as Anna walks into Harrods, Anna picks up the bag and she starts walking out of the store, digital wallet, digital ID, it's paid for, and it says, hey Anna, do you want an NFT or non-fungible token for that? And Anna will say, of course I do, because I want to prove I've got an authentic Louis Vuitton Speedy handbag. I don't want a counterfeit one. I want an authentic Louis Vuitton Speedy handbag. So that's great, Anna. So that NFT you can use as a wearable on your avatar for when you and your husband go and watch Beyonce in Fortnite this evening. So that's how we're seeing the connectivity between the industrial metaverse, supply chain metaverse, and consumer metaverse. And we're seeing examples of that today. So looking at, again, another way that this has been used, bringing it back into the real verse, if you like, looking at IBM Hyperledger and IBM Food Trust. So this is looking at how do we connect into existing supply chain networks and blockchain ecosystems that our clients are using. So again, you've got this SIM card, it's got digital wallet, digital ID, blockchain ecosystem, and smart contracts. So if we look at this particular example, so IBM Food Trust, if you haven't heard about that, that has about 500 different suppliers on there, so Nestle, Carrefour, Unilever, etc. So we're looking at how do we use these different technologies to provide end-to-end solutions. So in this example, it's looking at crop to cup, and it's looking at the coffee beans being picked in Vietnam, for example. Within the truck, you've got this SIM card as well. It's connected into the engine, so you can see how much carbon's been burnt. Thank you very much for the reminder. As you can tell, I can talk about this for a while. So this is looking at how do we then, the beans get put onto the back of the truck or the lorry, it gets taken to the port, then it gets put onto the ship goes to Vietnam, it gets delivered to the retail and roaster. But the important thing here, using the combination of technologies, again, we're able to embed FX, payments and financing. Because we're measuring the carbon that's been burnt, we're able to provide carbon offsets in real time. So I've gone through some of these, but just a quick recap. What we're seeing our clients using this for is gaming, media and entertainment, e-commerce and retail, and there's some big brands there, manufacturing, and also architecture and engineering. We too have been active in the metaverse, and typically this is how the conversation starts within corporates. It's, Mark, I've got this company that needs to talk to you urgently. They want to talk to you about crypto. And I say, really? And they say, yeah, they want to talk to you about crypto. I say, okay. But actually what's happened, similar to what happened with HSBC, our brand and marketing guys went crazy in the metaverse, bought a plot of land in the sandbox, and now we need to fund that in cryptocurrency. So what we're seeing is that companies like HSBC and many others, we are active in the metaverse. And so for the Rugby Sevens tournament recently, we did advertising within the sandbox to promote the competition that was coming up. We promoted and supported local artists in Hong Kong and stood up a metaverse art gallery as well, highlighting NFTs. So what does all this mean? So for us, it's how do we set ourselves up to be the banker of things? How do we set ourselves up to be that digital bank of the future? How do we help connect the metaverse to the real verse for our clients? How do we help store, convert, and pay the monies that have been earned through this new distribution channel that our clients are using today back into the real verse? That's what we're looking to do. And we're seeing some really interesting use cases coming up around that. There are, of course, some challenges around this, regulatory and legal. We need regulation to help us out, legal and the different legal jurisdictions that we need to work within. Technology maturity and industry readiness. I've been pleasantly surprised how quickly the technology is evolving around augmented reality in particular, and mixed reality, but also in the metaverse. I've talked to clients when I've been in London, in Germany, in the metaverse. Interoperability is going to be really important. Again, how do we connect the metaverse to the real verse? How are we able to bring those different digital currencies and assets back into real bank accounts? So to wrap up, as you could probably tell, we're active in digital currencies and assets, and that provides a safe on-ramp to new digital assets and distribution channels. The metaverse is emerging and broad, and we have many building blocks for Web3. But like the internet in the 90s, and again, for those of you who are old enough to remember, the internet in the 90s was an occasion. You had to go and you had to use a dial-up modem, you had to go to a specific room into the house in order to look at a web page. Now you can access it via your phone, right? So we're in that dial-up stage, Ask Jeeves, Netscape stage. We're in very, very early stages of the metaverse. However, what we're seeing is our clients are starting to adopt that, and we listen to our clients, and we're here to serve our clients, so we're looking at how can we partner with our clients to move us forward. So with that, I will stop talking.
Thanks a lot, Mark. So maybe we don't have time for question, but you will stay around. But just a final comment. It's good to see that HSBC is really leading the edge, and so you are addressing things that will be common in a couple of years. We don't know exactly when, but we are still, as corporate treasurers, and especially in the B2C, just starting considering the digital euros that is on the discussion with ECB and the EU. We need a framework, as you mentioned. We need regulation. We cannot do what we want, but people and some of our members, especially the B2C businesses, are looking and contemplating that, and so it's good to see that you are ahead of the competition and you propose some solution that will be common in a couple of years. I don't know when, but it's coming. So thanks a lot. Let's move to the last presentation.
Thank you.
So, good evening, everyone. Thank you for being here. Thank you, Francois, for setting up this conference, and also PwC for having us here in your offices. What I'll do is I'll just start very quickly with a video, and after all, we'll get to move on with the presentation, if that's okay with you guys. And I'll be sure to be on time and finish faster than with actually. Okay.
The bishop can easily fall victim to what we call an overload tactic. When one piece has to defend so many pieces, there's always a problem that there's an overload tactic and he may go down. Gary is not, he looks, I mean, he looks, we very, what, are we missing something on the chessboard now that Kasparov sees? He does not look, he looks disgusted, in fact. He looks just, and he went on, and he should get an Oscar, an award, and he should get $300,000 for it. And whoa, he looked Kasparov after the move C4.
So, a very quick question to the audience: do we have any chess players in the room? You can raise your hand. Don't worry, it's not a trick. I'm not going to ask you to come up on stage. So for those of you who raised their hands, and even for those of you who didn't, do you remember this particular moment? It was in 1997. Not at all? Come on, guys. Yes, you do. So basically, this was the second time Kasparov played against IBM and actually lost. What happened is that the first time around, Kasparov won against the machine, but what he didn't know at the time is that the machine, just like humans, are able to learn. And by practicing, they're able to learn more. What we're trying to do here, so please bear with me as I'll try to illustrate my thoughts, is that we're going to first talk about AI in general and how it applies to our lives on an everyday basis and how it's very efficient, and how we can apply it to finance. So we're not going to compare a human brain and a computer, because obviously we're not comparing apples with apples and it wouldn't make sense. But we're going to talk about how and comprehend how they differ and how we can make something out of this. So what a machine does, what AI is doing basically, is it's able to collect facts. It collects facts on a much wider ranges than the brain does. It also digests much more loads of information than what you can capable do on a daily basis and crunch data. Once it has done all of these things, it creates patterns. Human brain also does that, but in a less efficient way, if I can say. Once it had created patterns, it actually makes three things. It detects any glitches coming out of those patterns. It also makes suggestions in order to follow up with those patterns and creates forecasts. And this is where it's becoming more interesting for us. So before jumping into finance, let's focus on how AI is pretty much all around us already. So I'm sure all of you have already done some shopping on Amazon, and once right before doing the checkout, you buy a book, and then the portal, the shopping portal, offers you more books to buy, not only to make more profits, but also to make you smarter, because you need to read to be smarter. This is like the basics of IA and how it applies to us every day. What's get a bit more interesting and more sophisticated is where you add intent and situation to II. Meaning that, for example, when you go on Google Translations, you use contextual AI, and it gives more sense to the result that you're getting out of the machine. If I have to give an example, in English, for example, you have a word that means two things, nails. So nail, it can be whatever you have on the tip of your fingers, but also the thing that you smash with a hammer. Well, let's say you're in Japan or in Paris and you need to actually translate that word. You want to be sure that the machine doing the translation gets the right word and distinguished what word you actually need to be translated. And this is why what contextual AI does, it puts into situations. Last but not least, self-driving cars. I don't know if we have any insurers in the room. No, they're all left. Okay. So come to a point, I know they're being very cautious into insuring this risk, but they'll have to one day insure those risks. What's pretty fascinating is actually you have a machine, when you think about it and when you try to put some thoughts into it, that you have a machine that's moving, and while it's moving, it's encountering external data like, for example, traffic, the weather conditions, and also other vehicles moving, and even pedestrians. So those are the external factors that the machine encounters. It also encounters element inside the car. How many people are in the car? What's the temperature in the car? How much power left in the engine for you to get from point A to point B? Once it has done this, it actually is more efficient than you driving the car because it does it in a more safe manner. Why does it do that? Because it won't be bothered by any distractions coming from people talking next to you. You won't have also the risk, for example, of maybe drinking one or two wines of glasses before getting into the car. So it's safer, it's more efficient, and this is how AI is shaping our lives. So here, when we decided to do this presentation, what we did, or actually what I did, is I started to read very technical articles about what is IA, machine learning, deep learning, neuro-linguistic processing, all those very technical things that don't mean a lot to you, but the results actually do. So I figured it would make actually sense for me to create some content coming out of ChatGPT. So I basically asked ChatGPT, could you please tell me how AI applies to finance? And he came up with 7 answers. 7 answers that I was, of course, able to gather, but I wanted to challenge the machine to see if it was as smart as me and if I was able to be replaced in the machine, like some of us are asking ourselves, am I going to be replaced by IA? So the 7 answers that came out are first fraud. Of course, fraud is something that's very basic to AI because fraud AI is able to install patterns. And every time there's a glitch within the payment pattern, is it about the frequency of the amount of the payment, then the machine is able to draw back an alert. Risk assessment and underwriting also are areas that apply because the machine is capable to digest so much information coming from so many sources and also at real time that it makes your risk assessment and your portfolio investment, for example, much more relevant than if it was a human behind it. Same goes with underwriters. We know that updating premiums for an insurance company is always a big matter because it needs to go back to the actuaries who will then challenge the data. Here you don't need to challenge the data, you don't need to spend a lot of time on it because obviously the machine will do it for you. Trading and investment also You also mentioned it in your previous presentation, so thank you for this transition. What the machine and the computer does, it creates millions of scenarios in 1 split seconds. And at the same time, it's also able to execute the same amount of trades for optimal pricing. Then customer service, that's the funniest one, and you guys have been also experimenting that in Chatbox, for example. But those are very limited to simple queries and provide assistance, but in less complicated manner. The main advantages of this is that it gives you the ability for a company to do a triage between people that actually need to be connected to a human and people that queries can be answered by a machine. So customers are happier because of that. Robot, AirPA, and compliance. I'm going to put it all in the same box just to be conscious of time. So robot, don't worry, you're not going to have a robot in the office asking you if you need any assistance. That might happen at Google, but not here at least. What the robot does basically is, let's have an example, for example, during audit procedures that happen every year. The machine remembers what the auditor asked the previous year. So basically he's able to go and get the right documents and store it in the right place for the auditors to come and pick it up. It's also able to consolidate all this information and do the appropriate reporting based on the compliance request that you're getting. So again, more efficiency, and because it's more efficient, it makes more sense in financial processes. So once ChatGPT has answered this, I wanted to deep dive a bit more into why it's specifically more relevant in finance. And I already started to give out the answer. It's because of financial processes. Financial processes are very manual. They're very manual, they're very time consuming. So data collection, modeling, reporting, investing, hedging, pretty much all the things that you do today, no matter how complicated they are, they're still well-defined and very consistent. And even if they're complex, once you divide all those tasks into much more smaller tasks, it's become very easy for automation to get in. And that's where AI kicks in. So I'm not going to go into deep dive into the technicalities of AI. I just wanted to give you a very straightforward, concrete example of how AI can impact treasury specifically, and start with the business case. So we have a solution called GetPaid. It's a receivables management solution, and we have a client that decided to implement this solution in its treasury structure. It's a 2 billion euro logistic company located in the US, and thanks to that solution, they were actually able to reduce their DSO by 15 days. For a 2 billion euro company to reduce their DSO by 15 days, that means concretely 100 million euro gain in terms of cash flow every year. When we know that the interest rates are going as high as they are, I know that you have probably some ideas of what you can do with 100 million euros if you had it in your bank account. At least I do. So GetPaid, what's GetPaid? GetPaid is based on AI and in 4 layers of AI. As I said, you know how you divide complex sequences into much more simple one? This is exactly what we do. So AI and credit risk assessment. Here the solution is very efficient because it's capable actually of having you provide your own credit scores to your very own client. So it takes past payment data, past payment behaviors of your client. It also integrates credit scoring from external sources, and it mixes them together. Once it mixes them together, you get the information that's related only to you. When you do that, you're able to automatically set the correct credit lines and also update those credit lines depending on your customer's behavior. So that's the first step. I would say even before the invoice actually comes up. Then you have what happens during dispute management. So what happens when a client doesn't pay, but he's not happy about the invoice that he receives? what we know here is that a lot of time is lost between what I call the Bermuda accounting triangle. So the accountant gets the rejection or the invoice is not paid, and then he calls the client saying, okay, you haven't paid your invoice, and then the client doesn't respond, so he sends a mail, he sends a first mail, and what usually happens is after 3 or 6 months, either it escalates if the amount is very important, or it ends up in the sales desk. And then the accountant comes and sees the sales guy and say, okay, your client doesn't want to pay, so we're going to cut off the solution if he doesn't pay by the end of the month. And then you're a salesperson. How am I supposed to handle any disputes matters? Here, what the machine does is, depending on the dispute type, depending on the amount, and also depending on many other variables, the solution actually sends back and routes to the efficient person within the company to be sure that it's handled. You get to get a notification every day to be sure that it's handled, and you also get to track where the dispute is going. So that's the second layer. The third one is in collection in itself. Here, the AI within Get Paid basically is able to assign specific collection strategy depending on the type of the client you have. Is it a VIP client? Is it a Fortune 500 client? Is it a client that we just got in and we don't want to lose? It takes all those, I would say, qualitative ingredients and be sure to assign the correct strategy towards it. Last and not least, there's an AI that we call Carla. So Carla is your assistant whenever you get into Get Paid. Basically, it first helps you to navigate through the system. So it's kind of like having a Google within a system. So whenever you need help finding a file or finding a person or finding a phone number, whatever you're asking her to do, she'll basically do it. She's even able to interpret emails. And this is also a strong support regarding all of the AIs that I mentioned before. So, will that make sense to some of you guys? Does it sound familiar, more specific to HSBC, of course? Okay. So, once you have said that, the question here is not, should I implement AI somehow in my company? Because obviously, you're not going to be replaced by AI, but you might be replaced by somebody who knows how to work with AI, and that's the main difference. We know because we're a fintech and because we've been implementing solutions for so long, that successful implementations rely on 4 main pillars. First one being sponsorship. So you need somebody at board level who understands the ROI coming from this new technology. You need talent. You need somebody expert, either it's internally or externally, to support in the knowledge communication of that technology internally. And also, of course, and that's where I come in, it's everything running software, because we have the technology that we give to you, that we share with you, and this is a partnership based. And also experimentation. Have you ever went through a digital transformation? Have you implemented, I don't know, like a TMS or even ERPs? Have you ever done all those things before? And if you answer no to one of those questions, my first response to you will be, and this is the first question I ask when somebody comes and says, okay, I want to implement a TMS, my first question is, okay, are you supported by somebody? Are you supported externally by an advisory firm, first of all? And are you supported internally by your management to do so? Because if not, then we need to start and trying to figure out what's the target operating model for you. I think I'm pretty much done here. I know you guys want to enjoy the terrace and the cocktail. So I'll just finish very quickly about FIS. So, she's telling me I have time, but people will get to enjoy, 5, okay. People will get to enjoy the sun more, and I know it's very precious in Luxembourg to enjoy the sun, so I'm not gonna hold you for that. So FIS goes, of course, beyond treasury. So we've been working with banks. FIS is a 55-year-old fintech, and it's a Fortune 500 company. So it's been there.
It's not a startup.
Yeah, it's not a startup anymore, although I like to say that because it sounds sexy. We've been working with banks, so we offer banking solutions, solutions also for corporates. We generate 35% of all the global SWIFT traffic. I know it doesn't seem much, but it's actually quite a lot in terms of dollars. When someone asks me who do I work for, I work for a company who make money movement efficient and safe. across the world. It doesn't sound like something easy to do. And when we're at work and when we're experiencing, for example, new product discovery, what we tend to say is that FIS makes the impossible possible. So that's where I wanted to finish. If you have questions.
Do you have any questions for Mina? Maybe
you guys really want to drink something, right?
Yeah, exactly. No, but thanks a lot. Very interesting. And you mentioned just an area around collection, but we can certainly mention example on cash flow forecasting.
Cash flow forecasting.
Everywhere when you have pattern, you can counterparty risk. That could be maybe used also for bank counterparty risk, prevention of fraud, so problem with payments to get alerts. So I'm sure that so many areas where we can.
No, actually, it is a fact. What I did before doing this presentation is I took all the 7 components that ChatGPT was able to gather, and I started to put every FIS product that had AI in it that matches a specific ChatGPT component. And then when I've reached about maybe 40 or 45 product, I said, okay, it's not going to make sense anymore. Basically, all of our solutions are AI based. To some extent, simple or much more complex. It depends really on the solution in itself. But yes, we have a lot of solutions on the shelf.
And it's only the beginning. I'm sure that you have more and more solutions coming.
Exactly.
So I think thanks a lot for this presentation. So a round of applause. So now it's time to close the conference. As you rightly said, to go to the cocktail, you deserved it. But before closing, just 2 reminders. Our next event will be on the 5th of October for the annual conference, the 29th anniversary of ATEL. So you are more than welcome. It will be at BGL, not far. And the next one will be the 30th of November at Centre de Conférence, close to the Philharmonic, where we will have the Tech Day. So more than welcome. Half a day dedicated to technology, and some of the sponsors are already in the room. So it will be quite interesting. So really encourage you to come and join us. First, I would like to thank PwC for hosting the event and organizing this cocktail, but also thank the 3 other sponsors, HSBC, FIS, thank you, Mia, and HSBC, Arendt, and FIS. So, very interesting. I want to also wish you all a deserved summer break. Enjoy your holidays, and before, let's share a drink at the terrace. So you need to go upstairs, go the other side, and you will see the terrace, and enjoy the sun, or at least the good weather. Thanks for attending, and see you very soon.